This is the ultimate divergence trading video that will help you understand, trade, read and find the best divergences on any market, on any time frames and for any time. So let's get into this video. Being able to read a divergence the right way and to find divergences is important because divergences help you understand when a trend is likely to be over and to end so that you can time better exits. A divergence can also help you find better trending entries. So when a divergence occurs, very often the market will turn around and you can find new trends very early on. And also, if you know how to read a divergence and understand the principles behind a divergence, you will be able to gain a much deeper understanding of wave analysis, price, trends and momentum. And all of that I will cover in this video. In this video, I will use the stochastic to find divergences, but you can use any indicator such as the MACD, the RSI or any other momentum indicator. Usually the indicators will show you almost identical divergences all the time. And before we get started, we can do some really interesting modifications to the stochastic. So by default, we have the 1413 setting, and usually your stochastic looks something like that. You have two lines. However, to find a divergence, we can get rid of the blue K line and just focus on the orange line. It is much easier to find a divergence, is also a little bit more objective. And a divergence basically means that the indicator and the price action are doing different things. We will find out why this is the case and why this is such a cool and interesting signal in a moment, but this is the basic thing that we want to look for. We want to look for when the indicator is making, for example, a higher low and the price action is making a lower low. So you can see the indicator and the price action are not agreeing, which is actually where the word divergence is coming from. So the price action and the indicator are diverging. And so let's get into the nitty-gritty and the really interesting parts. Okay, since we're using the stochastic indicator, we should know what the indicator is actually doing. And the stochastic is not only a simple, but also a very fascinating indicator. And the stochastic asks the question, is the price close to the high or to the low? And is the price pushing up or down very strongly or not so much? And let's see what this means on our charts. I would always recommend, if you want to understand an indicator, set it to the period of 1. For every indicator, you can change the period setting, and I would recommend set it to 1 period, because then you will gain a very deep and easy understanding of what the indicator is actually doing. So here I set the indicator, the stochastic, to 1. So we're only looking at the current candle, and we only have to analyze the candle. And as I said, the stochastic asks the question, how strong is the price pushing up or down? And we only need 3 points here. We need to take a look at the high. So the highest point of this candlestick is here. The lowest point of this candlestick is here. And the close of this candlestick is here. And then we can simply ask ourselves, is the close closer to the high or to the low? In this case, you can see we are almost in the center of the candle, maybe a little bit closer to the top than to the bottom. And the indicator will analyze that and find that out as well. So the indicator is giving us this confirmation. You can see the stochastic is here at the 60 value. By the way, in TradingView, it says it's here, 57.48. So basically it means it's a little bit closer to the high because it's above the 50 level, but it's almost in the center. So that's a very first interesting finding in understanding the indicator. Let's look at a few other examples. So here again, we look at the highest point of the candle, we look at the lowest point of the candle, and we look at the close. In this example, we can see that the close is very close to the high and it's quite far away from the low. So what this means is that the price is pushing up in this candlestick quite significantly. And it's a very bullish signal if the price is able to close very close to the high. And you can see the stochastic, again, set to 1 period, so we're only looking at this one candlestick, confirms that here we have a value of 85.54. So the stochastic shows us that we are very close to the top, probably around 85% to the ultimate top. So it's a very bullish signal. Another example now is the highest point here, the lowest point of this candle is here, and the close is here. In this example, the close is obviously much closer to the low than to the high. And the stochastic shows us that as well. We are here at 15.57. So you can see the stochastic confirms that we are looking at a very bearish candlestick. And because the close is so close to the low, it is confirming this strong momentum to the downside. Last example before we move on. we are looking at this doji. We have the highest point here, we have the lowest point here, and the close is here. So you can see the stochastic is at 55.6. All right, so even though the candlestick is red and many people would say it's bearish, the stochastic shows us that it's at 55, which means it's a little bit above 50, which means it's a little bit above the center. So the candlestick, it is closing higher than halfway through the middle. So it's actually a slightly bullish candle and not, based on the color, a bearish candle. So very interesting finding. When it comes to trading, finding and understanding divergences, we use our default stochastic setting, which is 14 period. And then this is the indicator value or the indicator shape that we get. And this means that the stochastic is looking at the last 14 candles, and the same principles apply. So the yellow box shows the last 14 candles. And we just have to ask ourselves, where's the high? It is here. The highest point of the last 14 candles is here. The lowest point of the last 14 candles is here. And the close is here. What does it mean? We can look at, is the close closer to the high or to the low? And you can see the close is much closer to the high than to the low. And the indicator confirms that. We have a 70.8 stochastic value. So the indicator just confirms that over the last 14 candles, we are currently still at a very high reading. We are not at the top was here, but you can see we are still quite bullish. Now we're looking at a bearish scenario. We are still at 14 candles, so the yellow box analyzes or shows us where are the last 14 candles. And again, we look at the high. The highest high is here. The lowest low of the 14 candles is actually here, not here where the error is. And the close is here. So you can see the close is actually very, very close to the low, because here is the lowest low and the close is almost there. And the indicator confirms that it is at 1.5. So 0 is the absolute maximum. If the stochastic is at 0, it would mean that the close is at the lowest low of all 14 candles. Conversely, if the stochastic shows you 100, it would mean that the price is closing at the highest high. 1.5 is an extremely bearish reading here. And it shows that the low is actually here at almost at the close. So very, very interesting study here. Another final example before we move on to indicator divergences. We have the highest high here. We have the lowest low here and the close is here. So again, when we look at it, the close is much closer to the high than to the low. And the indicator here is at 81. It is much closer to 100% than to the lowest point, obviously. And you could interpret it such as, right now the price is 81% at the highest high of the range. So we have the ultimate range and price is closing 80% towards the top. So this is how the indicator for 14 period uses the same principles as what we would use when we set it to 1 period. So that's why I would always recommend set it to 1 period first, and then you will understand the indicator. And now let's move on to our divergences. So when the stochastic meets wave analysis, that's where we find divergences. So the stochastic is an ideal indicator to compare the strength of trend waves and to gain a deeper understanding of what is actually happening on our charts. Is the bullish side stronger? Is the bearish side stronger? Who is gaining momentum and who is losing momentum? So when we look at a broader picture, and we still have set our stochastic to 14 periods, we can look at different waves. And in this uptrend, you can see that the market is always going back and forth, up and down. And I've talked about this rhythm of the market many times. In an uptrend, you will see that the market is going back and forth, back and forth, back and forth. And this is how trends exist and how trends are created. However, not every trend wave is created equally. And by understanding the size, the strength of the trend wave, we can gain a lot of understanding of what is happening. So looking at this example, we have 3 trend waves. The price pushed up once, twice, 3 times. However, we can already see that the length of the trend wave is much different, obviously. The first trend wave, and I marked the 14 candles here based on the stochastic, you can see this is a very large box. So the market moved quite a lot in 14 candles, whereas when we compared here and here, the boxes get shorter and shorter, which means that the trends are less and less strong. That's a very important signal. And you can also see that for those 14 candles, we are often not able to close at the highest high point. Whereas in this first trend wave box, you can see the market is able to push to the highest point for 14 candles, and here you can see we're almost at 100 reading. Whereas in other boxes and the other trend waves, we are not able to push higher that much. You can see the market often leaves wicks and is not able to close at a highest high as easily as previously. And this is how a divergence is created. And that's really, really an important fact, because it shows us that the divergence is actually a signal that looks at the broad trending structure. It looks at how strong are the trend waves, how strong is the market pushing higher, how close is the close of those trend waves, are we seeing a lot of rejection at the tops as we did here, or is the market easily pushing higher? So the divergence is actually a very, very important signal. And you can see afterwards the trend here to the upside, the uptrend after the divergence is not only over, the market was not able to push higher, but the trend really rolled over completely. And as soon as the bullish side and as soon as the bullish buyers withdrew from the market, maybe they took profits, and the sellers, the price was high enough that it was interesting for the sellers to get involved, the market really turned around and collapsed. So it's important to know about the divergence, because it helps you understand when is the uptrend likely to be over and when is a downtrend likely to start. Another example, we are looking at a downtrend and we're looking at 3 trend waves. First trend wave, second, third. And you can see that we have a divergence. Here's the lowest low of the wave 1, here's the lowest low of wave 2, and here's the lowest low of wave 3. And you can already see that the stochastic is making higher lows. What does it mean? It means that in each trend wave that followed after wave 1, the market was not able to push lower that much and also not able to close that low. And we can see that here, you can see the box is very large, very high compared to wave 2 and wave 3. Each box gets smaller and smaller. Also, you see more rejection. There's a lot of candlestick wicks here suddenly, and the market is not able to push lower that much. There's a lot of opposition here, and this leads to the divergence. And how you would approach it is, for example, you could look for where are the swing highs in this downtrend. As long as the market is able to make lower lows and lower highs, the downtrend is not broken yet. The divergence is your first heads-up signal that something is changing, but just having a divergence is not enough to get into a trade automatically. I would recommend look at the highest points, where are the high points of the trend waves, and then look at a structure change. When the market is breaking above a previous high and making a higher high, that's often a good signal to start looking for buying opportunities. And you can see this is what happens. The market started making higher lows here, and then it also made higher highs here, and then the trend rolled over. But the divergence is the first signal, because it shows us that although we are still technically in a downtrend, the downtrending waves are getting shorter and there's more opposition from the buyers. The sellers are not as strong and not as dominant anymore. So now that we know what the stochastic is doing, what the divergence is, and how to read trend waves, we can get rid of our indicator and find naked divergences. And this is a really important skill as a trader, because this forces you to pay more attention to the trend waves and to the little nuances of price movements. So let's take a look at an example. And let's look at this chart. What do you think is happening here if we would put on a stochastic? We're having a downtrend and multiple trend waves. Do you think that there is a divergence? Yes or no? Pause the video, think about it. And yes, there is a divergence. Why? Because looking at the trend waves, you can see we have trend wave 1 here, very strong, very long. Trend wave 2 is much shorter than trend wave 1, and trend wave 3 is even shorter than trend wave 2 and trend wave 1. So every subsequent trend wave is getting shorter and shorter, and the price is not able to push as low. We use our stochastic here, and you can see we have the lowest point of wave 1 here, the lowest point of wave 2 here, the lowest point of wave 3 here. And you can see the stochastic is making higher lows. So we don't necessarily need the indicator if we know how to read price action and if we know what to look for in trending waves. However, having a stochastic or having any indicator is giving you objective confirmation on what you're actually seeing on your chart. So it doesn't hurt to have an indicator, because your analysis becomes a little bit more objective and also easier. And what we're going to do now is we wait for the market to turn around. You can see we are making already higher lows, whereas previously in a downtrend we are making lower lows. So we have our criteria of higher lows. Now we could wait for the market to break above this resistance level. That would signal that we would make higher highs as well. You can see the indicator of the stochastic is already pushing higher quite a bit. So it's supporting that the market is kind of rolling over. And this is what happened afterwards. So again, the market and the divergence is what started all of this. The divergence is our first heads up that the downtrend is losing strength. It's not necessarily a signal to automatically go long. I would always caution you with that and only use the divergence as an add-on confluence. But it's a very, very important finding because the indicator and the divergence is actually taking a lot of data points into consideration. And then if you can find other confluence factors such as higher lows, breakouts, maybe a break and retest, then you can build a very interesting trading strategy around that.